Let me just also point out the point that we're making about you can issue treasuries to cover the spending, or you can have the central bank issue reserves, and you'll still have to pay interest on those reserves then. This is what's behind our response to people that say MMT is about printing money. We don't argue that you need to print money when you spend. We don't even say that that's the way things should be done. If we did, it was in the context of getting around the politics of it, right? Pointing out that you're not finance constrained. Operationally, though, we have never cared, precisely because we know there is no such thing, that it all ends up being interest-bearing debt as long as you've got a positive interest rate target. Whether it's issuing bonds or not, you end up either with treasuries outstanding or overnight interest-bearing central bank reserves that the Treasury ultimately pays for. There's no way around it. Those are the two possibilities operationally. And so that's why it's wrong to say MMT just wants to print money. Now, MMT explains why printing money isn't actually a thing.
Excellent.
But we can always spend, and we can control the interest rate on the deficits that we run. That's what MMT says.
With that in mind, I guess the real question comes down to, we are led to believe that the national debt is something that is going to be passed on to our children. It is some horrible boogeyman. As long as I've been alive, it's been a thing. It's especially been a thing in the last 25, 30 years, with the national debt largely being not a thing. Tell me what the national debt fight is all about. What is the national debt and why doesn't it matter?
Well, of course, it matters in relation to inflation, right? But it doesn't matter in the sense that the currency issuer doesn't have to worry about its financial obligations the same way that a currency user does, right? If you had a printing press in your basement, would you care how much your debt was, right?
Right.
That's basically it. Now, the thing is, we've also been led to believe, and this is where the criticisms of MMT come from the mainstream. The mainstream will accept that when faced with it, right? They generally wouldn't accept it unless somebody put it in front of them, right? They generally keep saying the narrative about government has to borrow, et cetera, et cetera. But once they're faced with MMT, their response is, oh, yeah, we already know that. That's how they get around that. And then the next step for them is, yes, you can print money, but that's inflationary. That adds jet fuel to the spending, right? And that just shows their lack of understanding of operations because, as we just were explaining, there's no difference between quote unquote printing the money and issuing treasuries because either way you end up with interest bearing liabilities outstanding. And so the point is then also that you can control the interest on that. That is a policy variable. Now, it depends on how much monetary sovereignty you have,
Sure.
how much control you have over that interest rate. But when we're talking about the rich countries, because the other ones would take a bit too much to talk about the caveats and such and the opportunities they have, frankly. But if we're talking about the rich countries of the world, this is pretty much standard. This pretty much works for all of them. It's not a USA thing. It's not a reserve currency issuer thing. Australia, the central bank was just pegging interest rates on their debt. Japan pegs interest rates on their debt. A number of countries ran really, really large deficits over the last 2 years, and their central bank was accommodating a large percentage of this, Canada, the UK. This isn't just a USA thing. And now those countries also understand, if they didn't before, or at least their central bankers understand, that monetizing the debt wasn't a thing, right? They basically replaced treasuries with interest-bearing central bank liabilities that the government ultimately ends up paying the cost of servicing. So back to your point in terms of what the burden is, another thing people don't understand, again, if you control the interest rate on the debt, then you can set the interest rate low enough that the interest payments aren't inflationary also. That's the other thing that then the mainstream has a response to, which is when even a lot of our heterodox economists that have neoclassical economics envy behind a lot of their thinking is, well, if you set the interest rate below growth, eventually you get inflation because the interest rate's too low, you get too much credit creation, et cetera, et cetera. And The problem with that is there's all kinds of things you can do to slow down the creation of credit without manipulating the overnight interest rate and without messing with interest paid on the national debt. You can set those two things separately. And this is something that really MMT thinks about, and I haven't seen hardly anybody else talk about that. So if you split those two things up, you really don't run into that issue anymore. Meaning you can keep interest on the national debt low and you can manage credit conditions by manipulating debt service to income ratios or loan to value ratios or any number of things in the credit markets. New Zealand even thought about experimenting with tax rates added to interest rates to basically create an even higher interest rate on mortgages as something that the central bank could manipulate to adjust interest rates on mortgages over the business cycle or when there are bubbles or something like that. So anyway, there's ways, that's just one of them. There's ways that the central bank could more directly influence interest rates without having to raise its interest rate target and affect interest on the national debt. And economists just haven't understood the monetary system well enough, and it's not even part of their models generally, in order to have enough creative thinking about how to have more independence and policy space in running fiscal policy and monetary policy and get rid of these deficit phobias and such that don't and shouldn't apply to a currency issue.
Let me ask you one final question.
Mm-hmm.
So if I sell a treasury, let's say a 6-month treasury at X percentage rate,
Okay. Are you the government?
well, the Fed, whichever one makes up the national
Sure.
debt, okay, that percent of interest that I would be paying out on that particular debt instrument is the interest on the debt, correct? That's where the interest is coming from, is the interest rate of that specific single bond that I've sold.
Yeah, that's the component that adds to it. Yeah, right, right.
Okay. Each one of them may have different terms and conditions,
Mm-hmm.
different interest rate. And so the overall interest on this is an aggregate level of all those different interest rates and their expected
Mm-hmm.
payout. And what I'm saying is that when we go into this, we already pre-fund the interest payments on these things. Do we not? Do we not already account for that? That
I
was
mean,
what was told to me, was that basically the government already knows how much money it's going to pay off on these things.
well, it does in the sense that when it auctions it off at the auction, the interest rate, that's the interest it's going to pay that's set, right? And it already knows what it owes on the stuff it's auctioned in the past. And what that bond does in the secondary market after Treasury's issued it doesn't have any effect on what the Treasury pays. It only pays the interest rate that it was issued at. I thought where you were going with that might be the fact that you can only settle Treasury auctions with bank reserve accounts. Banks can only purchase Treasuries for themselves or for their customers at auction using their reserve accounts. So you need the reserves to be circulating before the auction, or you need the Fed to lend those reserves to them before the auction. And the way that the Fed puts those reserves out there historically has been by buying treasuries, right? Well, what's a treasury? Treasury is a previous deficit. So
Right? Yeah.
the thing about it is, even if somebody wants to quibble on that point, which I could get way more technical if they wanted to, but the key point is that you do not buy government treasuries at auction with private sector money. You buy government treasuries at auction with government money.
So let's round down to the very final thing here, and that is a famous MMT thing about ZIRP. Why do we sell bonds at all? What if we introduced a zero interest rate policy forever? What would that do? Why would that matter?
Okay, so the bond sales are for interest rate maintenance in terms of their operational function, as Warren Mosler put it many years ago. And we see this in many places in the world, particularly developing countries, where their central banks do issue securities, right? Which is kind of funny because if the central bank issues the securities, everybody knows the central bank can't run out of money, right? So we tend not to think of central bank as issuing debt, right? But that's exactly what they do. They'll issue short-term bonds to drain securities, and particularly in countries where they're dealing with a lot of flows in and out of the country in foreign exchange. They will use issuing their own securities as ways to manage their interest rate target. And that shows you the purpose of government bond sales. It's largely the same thing, to drain the reserves from circulation. Nobody thinks of central bank debt as being debt, but it should be obvious that when the central bank issues liabilities, you're talking about an entity that can't run out of bullets, right? But they still issue bonds anyway. They still issue securities anyway. So the fact that the Treasury issues securities doesn't mean that it's debt in the sense of you and I, right? Because again, the fact that you issue securities, there's central banks in dozens of countries issuing those. So ZIRP, first we have to recognize when MMT says ZIRP, or zero interest rate policy, we are referring to the very short-term interest rate, the overnight interest rate. We are not necessarily suggesting that every interest rate in the economy should be zero. In fact, we're not suggesting that. We're not suggesting that people be borrowing for a mortgage or something like that at 0%. That's not what would happen. We're simply saying the short-term rate, and really zero isn't necessarily where it has to be. It should just be really low, is our point. Short-term rate should be really low and permanently there, and central banks should use other means to influence credit creation, to influence, constrain, encourage credit creation. But what happens with the zero interest rate policy, even the mainstream understands that when you run a deficit and you don't sell bonds and the interest rate's zero, even Paul Krugman says this. This isn't exactly the way I would say it, but I'm going to say it his way just because it reinforces the point that we're not saying something that everybody disagrees with. When you issue bonds at 0%, the mainstream view is that your bonds are earning the exact same as money, or say it a different way. Money is earning the exact same as bonds. So money basically becomes like a bond, or the central bank reserves becomes like a bond, and you no longer get the jet fuel effect that they expect in their regular models. What they don't understand is there's only two ways to have deficits without bond sales, either ZIRP or you pay interest on reserves. Either one of those in their own framework mitigates that so-called jet fuel effect of printing money that they assume can happen when you don't sell bonds.
Ultimately, the concept of a zero interest rate policy, though, would allow us to not worry about bond sales. We sell bonds for a host of reasons. A lot of people find a nice, safe, secure, interest bearing savings account to be a great investment. I know that a lot of retirement in 401ks and pensions invest in these because it's a hedge against volatility. That said, there's also good reason to maybe not sell bonds. Randall Ray has been saying this for a long time that we should stop selling bonds altogether. What are your thoughts on that?
I think the question of whether or not to sell bonds entails a lot more than just the political narrative around deficits. Okay. So when Randy's saying that, he's talking to a particular audience and trying to bring home the point that if we didn't sell bonds, it would be pretty clear that the government doesn't need to finance itself, right? As a currency issuer. And so then you couple that with the fact that if you don't sell bonds, you are not doing anything much different from if you did, in the sense that monetization isn't something that operationally actually happens. Okay, meaning you don't add jet fuel to the deficit by not selling bonds. What matters is the deficit, not the financing arrangement. Okay, for macroeconomic impact. So that's one thing. There's a separate issue, which is financial systems at their very core in most every country, especially the richer countries, but even in others, run on a day-to-day basis on collateral. The best collateral is the government's debt. And if you don't issue bonds, the central bank is probably going to have to do it. So the point being, economists are going to have to get a little more creative about this to understand that the real purpose of government debt in the financial system is as collateral. It becomes money. This is why sometimes we talk about treasuries as being money. It is money. It's better than money, because money, meaning a bank account, when you're talking about the amounts that folks at the core of the financial system are holding, you're way, way beyond what deposit insurance covers. And so the treasury, the government bond, is effectively the money. And the government bond is the thing that you can sell immediately if you need to get cash. It's also the thing that you can use for collateral immediately if you need credit. And it's the most widely accepted collateral. It's the collateral that you take the smallest haircut on. And by haircut, I mean it's the deduction from your collateral in terms of how much of a loan you can get, right? So if you have a 10% haircut and you have a bond worth $1 million, you can borrow 900,000, right? So the treasuries have the smallest haircut. So in our financial system, we need safe debt for the system to work. Doesn't mean we need the government's debt. Central bank can do this. And as we were just talking about, central banks all over the world issue debt. They tend not to do it for this reason yet. But we like to say that, in fact, if the government stopped issuing debt and the central bank instead issued the debt to manage the financial system, you actually provide a lot more freedom and independence to the central bank, right? The MMT are the real ones that want to provide some central banks with operational independence. And people don't often think of it that way because they talk about us wanting to put the interest rate at zero, right? Again, that's just the overnight rate. We think central banks actually have a lot more things they could be doing to manage credit creation. We just don't think they should be using the overnight rate for it. And in fact, one of the things we think they should be doing is they should be able to have much more direct control over the safe assets. By that, I mean safe bonds circulating as collateral in our financial system, having control over the maturity of those, having control over the interest rates on those and such, and the haircuts and other various things. So let me say it a different way. There's no reason why the increase on a yearly basis of the safe collateral that our financial system wants to have has anything to do with the government's deficit. Right? There's no reason why those two are the same. But that's exactly what we do by having the government issue bonds to go with the deficit and the central bank not issue bonds. Right off the bat, you've created a good deal of difficulty for the central bank in managing day-to-day workings of the core of our financial system. Be much more efficient for the government to just spend out of its account, not issue bonds, have the central bank manage the rest of it. To do that, we have to get rid of the fiction that's inherently inflationary. When that happens, that means the central bank is captured by the politics of the government. We have to get rid of all of that stuff because that's where the mainstream of economics, that's their thinking on that sort of stuff.